Welcome. We're diving straight into Axon's Q3 2025 results today. It's quite a story. Huge growth meets a pretty jarring profit miss.
Yeah, that's the core tension, isn't it? You've got this phenomenal top-line revenue, really strong visibility with contracts, but then, bam, a big miss on the profit side.
Driven by near-term costs, as you said.
Exactly. And the market definitely noticed.
Okay, let's unpack that. So, headline numbers first. Total revenue hit $711 million.
Which beat expectations, right? Analysts were around $704 million.
Yeah, beat expectations. And get this, it's their seventh straight quarter of 30% plus year-over-year growth. Just incredible momentum.
Absolutely unquestionable demand there. But then, the bottom line.
Yeah.
Adjusted EPS came in at $1.17.
And the forecast was $1.52.
$1.52. So a miss of over 23%. That's significant.
Ouch. And the market reaction.
Swift and brutal. The stock dropped over 15% right after the announcement. Investors clearly did not like that profit shortfall.
It really is that classic high-growth dilemma, isn't it? Sacrificing profit now for, hopefully, market dominance later. But we should probably clarify the reported loss for you, the listener.
Good point. Because while adjusted EPS missed, the official GAAP number was actually a net loss. $2.2 million for the quarter.
Which sounds dramatic compared to the $67 million net income they had a year ago. That's a huge swing.
It is a huge swing on paper. But, you have to look under the hood. That GAAP loss is driven heavily by non-cash stuff.
Like stock-based compensation.
Exactly. Huge amounts of SBC, plus charges from all the acquisitions they've been doing. It's typical for tech companies growing this fast. So that GAAP loss, it's more accounting than a sign the core business is weak.
And the operational metrics seem to back that up. Adjusted EBITDA was, what, $177 million?
$177 million, yeah. Which gives them a pretty healthy adjusted EBITDA margin of 24.9%.
So operationally, they're generating good cash. It's the non-cash items, and we'll get into the R&D spending that pushed the official number negative.
That's the picture. And despite that EPS miss causing market jitters, management, well, they seem completely unfazed. They immediately raised their forward guidance.
Right. They really leaned into that confidence. Full year 2025 revenue guidance bumped up to around $2.74 billion.
Which implies 31% growth for the whole year, basically locking it in.
And their Q4 guidance, $750 to $755 million, that also beat what analysts were expecting for the next quarter.
It's a clear signal. Demand is strong. No slowdown here. And crucially, they kept their full-year adjusted EBITDA margin target steady at around 25%.
Which tells you they see this Q3 margin dip as, well, a temporary thing, not a structural problem.
Exactly. And when you look at the metrics that give them that long-term view, you really start to understand their confidence.
Like annual recurring revenue, ARR. That's the key subscription metric.
Grew 41% year over year. Hit $1.3 billion. That's massive predictable revenue.
But the really staggering number for me anyway is the future contracted bookings.
Oh, it's incredible. Up 39% year over year to $11.4 billion. Billion with a B.
Okay, wait. Let's just pause on that. $11.4 billion in future contracted revenue. Their current ARR is $1.3 billion. That's like almost 9 years of their current subscription revenue already locked in.
Pretty much. It's this massive backlog that gives them the luxury maybe to invest aggressively right now, even if it hits short-term profits. It fundamentally changes their risk profile compared to a traditional hardware seller.
It de-risks the whole model. And the existing customers. They're spending more too, right? The net revenue retention, NRR?
Still very strong, 124%. For a company selling both hardware and software, anything over, say, 120 is excellent. 124% is fantastic.
So what does 124% actually mean for the listener?
It means two key things. One, customers aren't leaving, churn is minimal. Two, and this is the important part, existing customers are spending 24% more this year than last year on average.
They're buying more services, more software tiers.
Exactly. Upgrading cameras is part of it, sure,
Yeah.
but mostly it's adopting those premium software features, AI, evidence management, all that stuff.
Okay, so demand is strong, future revenue is locked in for years, customers are spending more. Why did the gross margin shrink then? Adjusted gross margin was down 50 basis points to 62.7%.
Right, so there are two main culprits here. One is external, one is very much intentional. The external one, tariffs.
Ah, yes. Q3 was the first full quarter feeling that pinch.
First full quarter, yeah. And it hit the connected devices segment, tasers, drones, particularly hard.
How bad was the margin hit there?
For connected devices, the adjusted gross margin fell all the way to 52.1%.
Yeah.
Management was pretty direct. That was the main reason for the overall margin disappointment. Tariffs.
Okay, and the second reason, the intentional one.
Aggressive investment, particularly in R&D. They spent $177 million on research and development just in Q3.
Wow, $177 million. That's a huge chunk of change. Seems like that ate into the EPS number directly.
It absolutely did. But look at what they're spending it on. It's not just tweaking current products. It's funding totally new categories.
Yeah.
Like vehicle intelligence, that's the Axon Outpost and Lightpost systems you hear about, and cutting-edge AI stuff for their software live translation, the policy chatbot features, things that aren't making much money today.
So they're playing the long game, except lower profit now to build out and ideally dominate these future markets.
That's the strategy in a nutshell. Maximize scale, expand the addressable market now. And, speaking of margins, the counterpoint to the hardware hit is the software and services segment.
Right, the flywheel. How did that do?
Still incredibly strong. Adjusted gross margin there was 76.8%. And if you look at just the pure software part, still over 80% gross margin.
So that's the offset long term.
That's the plan.
Yeah.
Management basically called the tariff impact a one-time adjustment. It's baked in now. They fully expect that high-margin software growth to eventually swamp the hardware cost issues.
Okay, let's dig into the segment performance a bit more then. Software and services revenue grew 41% to $305 million. You mentioned the AI feature.
Yeah, that seems to be the driver. They said the AI era plan, which includes things like Draft 1 report writing, the live translation is their fastest booked software product ever.
Fastest booked, meaning fastest rate of new contracts signed up.
Exactly. It shows agencies are really buying into that next generation capability, not just basic cloud storage.
And even with the tariff headwinds, connected devices, the hardware still grew 24% to $405 million.
Still very strong growth for hardware, yeah. Driven mostly by people adopting the newer, pricier Taser 10 and Axon Body 4 cameras, which crucially push people towards the software subscriptions.
Got it. And those newer, smaller segments, form solution.
Accelerating like crazy, grew 71% year over year. Yeah. That includes things like counter-drone tech, VR for training, the fleet vehicle stuff. Lower margin initially, perhaps, but huge growth potential.
And you mentioned the quality of deals earlier, customers buying the whole package.
Yeah, that was a key point they made. 2 of their top 10 deals with state and local agencies in Q3 hit $600 per user per month.
$600 per user per month. What's the normal range?
Depends on the agency size and features, but think maybe $150 average is more typical. $600 means they're buying everything.
The most premium AI, the evidence platform, VR training, maybe vehicle tech. The works.
Exactly. It's proof. The full ecosystem strategy, getting customers deeply embedded, is really paying off with their most advanced clients.
And this push to connect everything logically leads to their next big move, Axon 911, the push into emergency communications.
It's a massive bet, built on acquiring companies like Prepared and the really big one, the pending deal for Carbine.
That Carbine deal is $625 million, right? Expected to close early next year. That's not pocket change, even for Axon.
No, it's a serious investment. Shows how determined they are to disrupt the, frankly, ancient 911 infrastructure market. They're paying a premium to get what they see as critical tech for their vision.
And the vision is ambitious, to say the least. Cut emergency response times down to maybe 120 seconds.
That's the moonshot goal for high-priority calls, yeah. By integrating call handling directly with AI and officer dispatch, they see Prepared and Carbine as 2 sides of the coin.
Oh, so?
Well, Prepared is like an AI layer you can put on top of existing 911 systems. Less disruptive, immediate efficiency gains. They mentioned one city cut calls needing a human by 33% using it.
Okay, quick win.
Right. Carbine, on the other hand, is the full replacement. A totally cloud-native, modern call-taking platform for agencies ready to rip out the old stuff.
Offer an easy fix and the full upgrade. Smart. And they're looking beyond police and fire, too, aren't they? Into enterprise.
Definitely. We saw the announcement of the Axon Body Workforce Mini, a smaller camera specifically for retail, healthcare, logistics workers.
So taking their tech into completely new verticals, when is that coming?
Expected first half of 2026. So that R&D spend is turning into products quickly.
And internationally, are they getting traction outside North America?
Seems like it's picking up steam. They highlighted closing a big cloud deal in Europe, a 9-figure deal just in October. That's significant because Europe has been slower to adopt cloud for public safety.
Okay, so pulling it all together for Q3, it's really this dual story, isn't it?
Absolutely. You've got incredible demand, that huge $11.4 billion backlog showing long-term health. But that strength is basically funding a massive, deliberate investment push into new areas.
And the cost of that ambition right now is lower near-term profit, thanks to R&D spend and those external tariff pressures.
Precisely. Management's message is clear. Forget the next quarter or two. We're building for the next decade, maybe longer. This is decades of growth, not next few years. It's all about grabbing market share across these new frontiers.
Right. It makes you think about that 9-1-N strategy and the broader implications. The CEO used that analogy.
A telephone analogy, yeah. Saying they're moving into voice communications that sits on ancient infrastructure, like old landlines. And you didn't have to throw out your home phone immediately when cell phones came along, but eventually.
Exactly. Which leaves you, the listener, with a provocative thought. If this AI-driven automation works for something as critical as 911 and then spreads to enterprise call centers, customer service, could it make today's legacy voice systems, the old hardware, the manual processes, basically obsolete, as irrelevant as the landline phone became?
It poses the question, doesn't it? Are we seeing the beginning of the end for some of the oldest, most entrenched communication infrastructures we rely on every day? A fundamental shift driven by AI integration.